require individuals to take action was our next question. Yeah.
Yeah. The citizens are required in 2014 to have and maintain qualifying health coverage. And that is a specific set of benefits that we can talk a little bit about later. The key to it is that if you don't do that, you have a penalty, and it's a graduating penalty from $95 or 1% of your taxable income in 2014 up to $695 or 2.5% of your income in 2016. And that's for each individual with a maximum of 3 per family. So you could face some substantial penalty for that. However, remember that you're exempt if you're below the tax filing threshold. And that this year is $93.50 on a single and $18,700 for a joint.
Okay. So that's the key. Notice though that what they've done is they, like we do with a lot of things, we've got this timed release that's happening, and part of it is because of our economic situation right now. They feel a lot of people can't afford this, and so they're hoping that we're going to be in recovery mode by the time that we get to 2014. And so people will be in a better position to move ahead with this. And so anyway, and as you mentioned, the increasing penalties, you know, moving from like $95 to $695, oh my gosh, you know, and it's a little bit like we've had this time bomb that we just went through with our tax laws, and now after 2010, the Bush tax cuts are going to end. Well, anyway, we're going to have something similar happening where things are moving related to our requirements. What is qualifying coverage?
Qualifying coverage is a set of benefits, which for most people that have employer-provided insurance today, it covers most of those things. It's preventive care and wellness, for one thing, for sure. It's hospitalization, it's ambulatory services, it's prescription drugs, it's laboratory, it's mental health, and those kinds of things. The qualifying coverage piece and the exchanges will be required to provide a level of coverage, and the design of this level of coverage varies from 60% actuarial value, which basically means that the plan is designed to cover 60% of the expenses. So we have the opportunity for 60, 70, 80, or 90% actuarial value coverage that will be allowed with the basic level of benefits that you need to apply.
Okay.
You know, I guess one of the questions probably is what do people need to think about? Individual people need to think about. And I think there's really 3 basic things that you're going to look at. Number one is if you're uninsured and you have a pre-existing condition currently, you're going to find out about that high-risk pool, because that's going to be great. There are going to be restrictions on premium and variations in premium based on the age and the family member. So that's a more detailed thing, but there will be variations on that. Certainly, if you have adult dependents that have aged out because of your plan, that's going to go away. In fact, I looked at an email service today, and it appears that many multiple insurance companies and HMOs are in the process of doing that right away. So we may not have to wait for that. And
now
then, of course,
let's talk about that a little bit for just a moment, because I think that's one thing that a lot of people are going to wonder about. So what's basically happened in the past is once your child reached 18, unless they went to college, then they wouldn't be covered under your plan anymore.
Couldn't be covered.
They could not be covered.
That's correct.
And then if they continued in college, I think after age 24 it went away, is that right?
Well, it varied by insurance carrier.
Okay.
So some were 24, some were 26. Generally, they gave a 4-year window. A few of them went to the 26 age anyway. But then once they were not any longer enrolled in school full time, they were required to age out of your plan.
Yeah, basically they had to get their own insurance.
Get their own insurance.
And
so
what's going to happen now with this plan? So
what happens now is that any of these folks that have aged out, either because of going to college or because they didn't go to school and they did something else where they don't have benefits,
right.
Those people are now going to be able to come back in to the parents' plan as a dependent. Now, with the caveat that any employer-provided premium for these dependents will be added into income of the employee, and the dependent child that's coming back in is not, they can't be eligible for their own group type coverage. Okay, so those are the parameters, but it's going to be a great deal for young people that are out trying to find a job, or they've got a job that doesn't have benefits, those kinds of things to come back coverage into the parents.
Don, we just have maybe a couple minutes left. Could you explain the exchange concept?
Yeah, Mike, the exchanges are going to be designed to again present to individuals and small employers currently as it's written a qualifying set of benefits at varying actuarial values. So it's another option to go to, and the idea of it is to create competition. So we want to have not only individual carriers, but we also want to have the people that are involved in the pool process. Now in California, we actually have had that before. We had the HIPIC, the Health Insurance Plan of California, for a while. And we have another privately run one down in Southern California called California Choice, which basically has multiple employers, similar plan designs, and people can select from among those.
Okay, so what the exchange idea is it's a central place that you can go where you will have choices for different types of medical plans that you can look at, and then they have different levels, as we said. So there's going to be like a bronze, gold, silver, whatever.
It's exactly, and platinum is the highest.
Platinum, okay, so 4 levels of coverage that's available. Obviously, they're going to have different premium levels that apply, and then different patient responsibility.
And I think too, along with that, they're required to provide a minimum level. So there may be companies and plan, there probably will be, that add into that to make these more attractive to their customers.
So Don, we just have maybe 50 seconds left. Do you think most people are going to be better off with these reforms?
I think certainly people that have struggled to get insurance in the individual market, at least in California, are going to be far better off than they are now. Having said that, it waits to be seen what the premiums are. If the premiums are going to be what the high risk premium are we have now, then they may or may not be better off. But in general terms, I think yes, definitely, certainly, young people are going to be better off.
Okay, we're out of time.
So talk too much.
Yeah, we did great. So folks, we hope that we helped you to understand a little bit better anyway what's going on under this new law that we're dealing with, and we hope that you can join us next time, and especially for our next program about the employer considerations related to this new law. So we'll hope to see you next time on Financial Insider Weekly.